Hey there, Jed Barker with Best Life Mortgage. I make these videos to help you understand the loan process better so you can make better financial decisions when getting a home loan. Today, what I want to talk to you about is a question that I probably get daily, if not multiple times every day, is what can I afford or what can I be eligible for when it comes to home lending? That's a great question. A lot of people don't understand how to calculate that. I'm going to give you some simple ways to calculate that because it isn't a question that you need to know so you can set yourself up for success. And so what I want to talk to you about right now is something called debt to income, the DTI ratio. You may have heard about that, but it's the debt to income ratio. All loan programs are going to go over that debt to income ratio, and you're going to have to stay within the guidelines. So I'm going to give you some quick examples now on how to calculate it. So the first thing you want to do when you want to calculate your debt to income ratio is, first off, you need to figure out what your debts are. And so you might ask yourself, what are my debts? Is it my cell phone bill? Is it or my groceries? Some people think it might be how much they pay on gas, but really it's not. It's your debts. Those are loans that you've taken out from other lenders that show up on your credit report. Sometimes they don't even show up on the credit report, but you have to disclose them. So those are the debts. These are the loan debts. So think about things such as student loans, auto loans, credit cards, mortgages, private loans, just anything really that's a loan or a debt that you have a monthly obligation on. Could also be child support. Think about that. That might not show up in your credit report, but it is a debt obligation that you have, and it will come into factor when doing your debt to income ratio. So the very first step is to figure out your debts. And one way you could do that, you could look at a copy of your credit report. You could come to a mortgage loan officer like me, and we could run a soft credit check for you to look up and pull up all of your debts and just sort of go through those together. Or you could do like a My Free Credit Report online and go through and look at all your debts. So get all those added up, all those numbers just all added up. So that's the first step. Add up all your debts. The next step you could do easily is determine, hey, ask yourself a question. What is my maximum mortgage payment that I would be comfortable making? Is it 1,000? Is it 2,000? Is it 5,000? Is it 10,000? Like what is that? What's that maximum mortgage payment that you're comfortable paying? Because this may help you determine, what's your debt to income ratio based off your own criteria or your own preferences, right? And so let's imagine for a minute you're doing this. You're looking at all your debts. You add up an auto loan, some student loans, maybe some credit card debt. Maybe it all comes out to, let's say, $2,000. Okay. So now we're at $2,000 of current monthly debts, terms or revolving. And then you say to yourself, the most I'd be comfortable paying a month is $2,500 in my mortgage. So now you have a $2,000 and $2,500. So what you need to do now is you need to take the $2,000 and you need to add $2,500 to it to give you a total of $4,500 between your debts currently and your expected new debt of your mortgage. That $2,500 should include your mortgage payment, your annual taxes, and your annual homeowner's insurance. So the total PITI payment is, that's what we call the PITI payment, or the total payment. And so if you take those, I'm going to pull up a calculator. I see that on my screen. I'll blow it up right now here on the screen so you can see it if you're on a smartphone. Let's imagine we're taking the $1,500, or did we say 2,000? Maybe we say 2,000. Say we take the $2,000 of current debts and we go ahead and add down here, the add button, $2,500 to it. We equal that. So now we have a $4,500 total debt load, including our new mortgage payment. Now we have to determine what is our actual income. Now in lending, there's things called qualified income and actual income. Qualified income is the kind of income you're going to be able to get qualified with, right? We'll have other videos on that. We can talk about that. You can call me on details on that, but let's assume now you just have a qualified income. You know what your monthly income is based off your salary or a full-time wage. And let's imagine for a minute it is $8,000. So let's do this. Let's take $4,500 divided by $8,000 equals 56%. So the percentage there is 56%. That is the debt to income ratio on the back end of what they call a debt to income ratio. And that's a mortgage ratio. Okay. And so that's your total debt load. 56% is actually going to be too high to qualify for anything other than probably an FHA loan. Although an FHA loan, you could qualify with 56% if you do have higher credit scores. And so you may not qualify for that $2,500 a month payment on a conventional loan. And so that may not work for you in that situation. So let's go ahead and do one more. Let's clear that out. Let's imagine you have $500 in current debt you want to be able to afford a $2,500 a month mortgage. And on top of that, you make $8,000 a month in income. You're at a 37% now debt to income ratio. You would most likely qualify for conventional financing with that, FHA financing, USDA financing, and VA financing. You would probably qualify that for across the board, all things else being considered. So let me go ahead and close this down now on that side. I hope that's been super helpful for you to sort of understand what a debt to income ratio is and how to calculate it yourself. I'm going to end there today, just giving you a quick lesson on debt to income ratios using a calculator so you can learn how to do that yourself. If you have any questions or needs or wants, understanding what you qualify for, there's a lot more that goes into a loan qualification than just a debt to income ratio. Things like credit, past history, on credit, as well as cash and reserves and finances. So contact me, let me know. I'd be more than happy to discuss that with you. Contact me through my number at 800-864-9251. You can also email me, contact details below, as well as just contact me through Facebook, social media, and online accounts. So look forward to helping you in the future. I'll talk to you later. Bye-bye.